Why adjust a protective put in the first place? Have you ever wondered why adjusting a protective put is so important in options trading? Let's break it down in a straightforward way. A protective put is an options strategy where an investor buys a put option to limit potential losses on a stock they own. This strategy sets a minimum selling price for the stock, which helps manage risk. However, market conditions are always changing, and that is why adjustments are necessary. One key reason to adjust a protective put is the expiration of the put option. Every put option has a fixed expiration date. Once that date passes, the investor loses the downside protection. To keep that safety net in place, the investor can roll the put option. This means selling the current option and buying a new one with a later expiration date. By doing this, the investor maintains continuous protection as long as they hold the stock. Another reason for adjustments is time decay. Put options lose value over time, especially if they are out of the money. This decrease in value can reduce the protective benefits of the put. To counteract this, investors often roll or replace the put option before significant time decay happens. This helps keep the hedge effective. Changes in the stock price also play a big role in why adjustments are needed. If the stock price moves significantly, the original strike price of the put may no longer provide the best protection. For instance, if the stock price rises above the put strike, the option might become too expensive compared to the protection it offers. Conversely, if the stock price falls below the strike, the investor may want to adjust the strike price or expiration to better fit the new risk. Volatility is another factor that influences the need for adjustments. When market volatility increases, put options become more expensive but also more valuable as protection. On the other hand, when volatility decreases, puts lose value. Adjusting the protective put in response to these changes can help optimize both the cost and effectiveness of the hedge. Cost management is also crucial. Protective puts requiring paying premiums, which can add up over time and eat into overall returns. By adjusting the put position, like selecting different strike prices or expiration dates, investors can balance the cost of protection with their desired level of risk mitigation. Lastly, market events can prompt adjustments. Significant events like earnings announcements or economic reports can lead to increased volatility or price swings. Adjusting protective puts around these events allows investors to tailor their protection to anticipated risks. In practical terms, adjusting a protective put often involves rolling the option. This means selling the current put and buying another with a different strike price or expiration date. This keeps downside risk limited while allowing the investor to stay long on the stock and benefit from potential upside gains. Overall, adjusting a protective put is essential for maintaining effective and cost-efficient downside protection. It helps respond to time decay, stock price movements, volatility changes, and evolving market conditions. This ensures that the hedge continues to serve its purpose as insurance against losses without sacrificing returns.